what were the big stories last week? What were the big influences on the market, and where we may go in the week ahead? Again, it's the kind of 1 month into the war in Ukraine, Russia's invasion of Ukraine, and we've kind of seemed to be arriving into month two, where this starts to feel, without disrespect to Adi, who had to live through the terrible Bosnian War, Bosnian-esque, in the sense that, is it reached a stalemate? Is anybody winning? Does this thing just grind on? My question to Christoph Ruhl to kick us off this morning, of course, Christoph, senior research scholar at the Center on Global Energy Policy, Columbia University. How long's a piece of string sort of question, Christoph. Has the oil markets now priced in the Ukraine war?
I think that happened some time ago. So the question is, has it priced in, or has it reason to price in a sort of gradual boycott or embargo of Russian oil? And here, just to remind everyone, what happened with the oil market situation and the sanctions situation is different from what we had in the past. In the past, when there were sanctions against oil-producing countries, this was all or nothing. It was one size fits all. Iran, Venezuela, Iraq before. Nobody was supposed to touch their oil, and if they did, there were secondary sanctions, and the US tried to infringe on sovereign countries, not to have their banks help to finance this, and everybody would be slapped on the hand. With the Russian sanctions on energy so far, they are completely voluntary. That means the US, for example, says we don't take Russian energy imports, but if India does, nobody is going to punish Indian banks for financing it. It's very different. And so this kind of, I call it sanction pitting, sort of horses for courses approach, escalated last month after when you look at the European countries. You have the EU trying to scale down Russian gas, but not oil. You have the UK scaling down Russian oil, but not gas. And so again, you have this sanction picking approach. And last week was a serious discussion whether Europe should stop importing Russian gas. And in the background was another serious discussion whether they could stop importing Russian oil. And I think the two decisions which have been made is to gradually scale down gas imports. That's where these 15 billion BCM come from, the gift from the US, and to back away from touching a European embargo of Russian oil because the disruptions would be too great. And so what this leaves us with is two interesting experiments. We will see if they are serious, we will see a very rapid movement away, curtailing gas exports from Russia into Europe, which then will be stranded. Just to remind everyone, there's no pipeline from Western Siberia where this gas comes from into Asia. So whatever Europe doesn't buy has to go in the Russian market. The Russian market is well supplied. It will not be sold, it will be a loss to Russia. And then there will be this interesting experiment of individual countries, always assuming they are serious, cutting down on oil exports and the oil from Russia being gradually redirected into other places, because as we all know, it's an integrated market. So whatever doesn't go to Europe will end up somewhere in Asia. But without the huge disruption, which would cause prices, which would cause a global recession. And that's an interesting experiment. And I think in oil, there's way to go. I think that we can talk about it separately, but if you do the appropriate calculations, current oil prices are not, a reason to grab for the panic button. We have lived within present terms, oil prices around 150 for 3 years, from 2011 to 2013, without a recession. Well, now the economic situation is a bit more dicey, but I think 100, 120 is doable. And that's obviously also what OPEC Plus thinks, but I stop here. But this is the game, sort of reducing gas. And the Germans, mind you, just have promised to wean themselves off Russian gas imports by 2024, which is quite something.
Let's welcome Adi Imsirovic, obviously a former head of oil trading at Gazprom. I think I'll just drop that in as for whatever relevant it is this particular week, Adi, but senior research fellow at the Oxford Institute for Energy Studies. The big story last week, Adi, I suppose, is the fact of the Biden visit to Europe, the NATO meeting, the EU meeting, the meetings in Poland culminating last night, and Biden essentially calling for the end of Putin's regime and the end of Putin. Your thoughts on Biden's visit last week and what impact it may or may not have on energy markets? Sorry, I don't hear Adi, but maybe because it's muted.
Sorry, my fault.
Yeah.
Well, good to be back, Sean. Thank you. I think the most important thing was the fact that Biden did come very, very close to the Ukrainian border there to talk to his European allies. Obviously, very different approach from the previous U.S. president, and he's clearly building an alliance, and I think he's preparing Europe for the long run. I think Europe and NATO have never been more united, and I think just the fact that Europe was talking about sanctions in terms of sanctioning oil imports from Russia is a very serious sign how serious the situation is. I would just add
but yet they've backed away from that. They haven't taken that.
They have, and I would just like to add one more comment. I think there's been a lot of talk about it. Most of the talk is based on the fact that Europe would struggle without oil. I somehow disagree there with that comment. So whoever made it, I think it was John Kemp in Reuters. I think the real reason why Europe backed off, of course, it's going to be hard. I mean, close to 3 million barrels a day. You don't substitute just the snap of a finger. But the real reason why Europe backed off was gas. Russians have clearly said that if Europe sanction their oil or ban their oil imports, which is the cash cow for the Russian economy, in normal times it was about 4/5 of the income, as opposed to 1/5 was gas. So the real money is coming from oil, not gas. Now it's somewhat different because of the relative prices change. And I think Europe realized that Europe cannot do without Russian gas. That's the problem. You simply can't. I mean, we did some numbers at the Institute. Even if all the IEA fancy policies are sort of implemented in the best possible way, and we know that famous 10-point plan, we would still be down probably about 15% in terms of the gas that we need for next winter. Lights would have to go off. They would have to go out, and Europe just can't do that. And the real reason is gas, not oil. Oil, especially seaborne imports, it will be tough. It will be very, very hard for Europe for refineries, especially inland refineries. They have very little storage. They're actually feeding hand to mouth on Russian supplies. But some of them do have alternatives via plots, via Poland. They have alternatives via Wilhelmshaven. There are other ways of supplying them. I think the main problem will be actually getting the madness of logistics of the current situation. I can tell you one thing: I'm very, very glad I'm not on the trading floor at the moment, because it must be absolutely mad, and not so much in terms of prices and fluctuations of $20 a barrel. It's tough, but traders can handle that. I think physical rearrangements of supplies, particularly on the product side, actually, because Europe is now losing a lot of half the products that they're supposed to be coming from Russia. I think it's going to be absolute madness.
Adi, just to come back on the point that Christoph made there, $120 oil, when you take all of these things into consideration, seems rather sober, right? It's nothing. And if you take it in the context of, obviously, Christoph referenced the last time we were at these levels, but of course that was 8-10 years ago when $120 was a bit more meaty. $120 meant something. We're now with 8 years of inflation, and yet we're 820 doesn't seem that dramatic a number given the scale of the situation. Your thoughts on that?
I agree with Christoph. I don't think it should be dramatic, provided the situation doesn't escalate any further. The current market is basically taking into account the loss of probably about 2, maximum 2.5 million barrels of oil, and that's priced in. It's in the price. Now, as we talked just before the show, we chatted a little bit. The military situation seemed to be a bit of a stalemate. There's a lot of noise, of course, but there is oil out there. The key problem now is to figure out these logistics, the oil that is not being sold. And actually, by the way, very few people know how much oil we are losing at the moment. It's almost impossible to calculate because it's just not being sold. So you've got a backlog. So the Russians have come out with April program, which is actually 10-15% bigger than last month, than March. Loading program. But that's actually because of the backlog of this oil that just hasn't been loaded in March and is going into April. It doesn't mean that it's going to be loaded at all. So
I did see a data point over the recent days that Europe has paid Russia $20 billion in the last month for energy supplies as just a fact of paying for the stuff they've got, which is kind of the sort of crazy backdrop to all of this. Christoph, I wanted to. Sorry.
There's an app which you can load which counts down that.
Oh, really?
It's pretty accurate.
Oh, God. I wanted, Christoph, to sort of bring this home a little bit for you, because when we use the word Europe a lot, Europe this, Europe that, we're really talking Germany here. I mean, I would say ultimately, what I took away from last week was the end of German independence in a way. We saw under Merkel all the noise about Nord Stream 2 and we need to make our own decisions and leave us alone and so forth. But ultimately, Germany has created a big part of this problem. I'm going to challenge you with that thesis in the sense that under Schroeder and Merkel, Germany essentially became completely dependent on energy gas, and either Schroeder or Merkel were both Russian agents or some version of, Russian apologists, that they created a situation, closing all the nuclear power plants. I'm putting that out there, slightly devil's advocate, but nonetheless, Germany is the Achilles heel of Europe when it comes to energy security.
No, these are good questions, but there's a confluence of influences. The most striking thing for me, as a sort of middle-aged German looking at this from the outside, is in which kind of rapid succession two very basic truths have gone out of the window. In my day, when I grew up there, when we were in Germany, it was always taken for granted, literally until a few weeks ago, that you didn't really worry about having an army. And it was a stupid thing to do and a money waster. Why? Because there would never be a war in Europe again. Germany had been so destroyed. They thought everybody had. And that was, I think, a shared belief with people in Russia, people in the Ukraine, people everywhere. That's why the shock was so big. And the second, there are many beliefs, but another very important one was that you don't have to worry about energy from Russia, no matter what the Americans are screaming about, because all through the Soviet times, it always came, it always flowed, no matter the political situation, crisis here, crisis there in Cuba, the gas would always come and the pipeline would be produced in Germany, delivered there. That seemed to be like the definition of a stable relationship. And so it took some time. And now to see this reaction of public announcement to spend 100 billion euros and break their own holy sacred budget rule for shoring up the German army, and then to say by 2024 we will have reduced Russian imports to a trickle, which I have very little doubt when they announce this they will do it. That is a real sort of pivot on a dime, and the gas thing is just as important as the military thing in terms of the mindset of people. It shows us that two things, that how deep this trust was and how deep therefore the disappointment by this attack on Ukraine. And that you actually, if you really want to, even in energy, which is such a slow-moving beast, you can accomplish these kind of things at a price. And the nuclear thing was a similar example of German pivoting overnight, because Germany was socially very divided, 50% for and 50% against, and they were really sort of antagonistic about using nuclear power, is that good or bad? And when Fukushima happened and opinion polls swung to 65% against it, so Merkel literally on a weekend announced we're going to cut it down. And that was that. And then they followed that plan. And as of yesterday, the public announcement from the government is we will stick to this. We will not reactivate nuclear plants. We will not allow them to run longer. We will allow coal plants to run longer. And this is by a government run by Social Democrats and Greens. So a lot of things have been turned upside down or maybe downside up. But we should expect that this will be executed, these kind of programs. And that means that that will be a message which will resound in Russia, because they will also be taken aback. Because, as I said, these were probably shared beliefs. And I think still many people in Russia have not realized that they really cut the tablecloth, as the Germans say, with this attack on Ukraine.
They cut the what, sorry?
Well, we have a saying, you cut the tablecloth, which means when you break relationships with somebody for good.
You cut the tablecloth. I like that. There's a lot of visual images of that. Adi, another big story last week, which I'm still sort of trying to get my brain around, the traders screaming for help. You mentioned it. You wouldn't like to be on a trading desk today, but there was a meeting, a forum. I think it was in was it Geneva? But anyway, all the big boys were there and saying that there's FT conference. There's going to be trading houses going bankrupt. They need much bigger credit lines. Where can you just sort of give us a sense of the stress in that space and how serious is it or not?
It's very, very serious. Numbers are not being disclosed, so we obviously don't know them. But from my experience in my previous job, you could easily have hundreds of millions of dollars worth of margin calls, and I'll tell you where they usually come from. They usually come from LNG trades. Most of the LNG trades, but these guys, they don't, the gas market, as we all know, is extremely volatile. So you cannot have, and there are still lots of long-term contracts, 10-year contracts. Once you get one of these contracts, let's say on oil-related basis, or you're selling it on oil-related basis, particularly India, up until recently, has been buying oil, buying gas, LNG, on an oil-related basis as well. You have to hedge those positions way out. So imagine all these cargoes per month times 10 years times the volatility in the current market of last week, $20 a barrel. You get, and obviously margins have been increased by the exchanges. So margin calls have been absolutely ridiculous. And I could just imagine that they are really, really suffering. They need banks, they need bank help. Of course, my answer would be, well, maybe they could just return some of those massive bonuses they did last year, and that would probably go a long way to help them. So I'm a little bit cynical about it, and because some of them have been actually talking to the governments, to their respective governments, asking for some help. But it's extremely serious. It's very, very serious. I can see margin calls, and some of those guys who have poorer credit, I think, are in real trouble.
Does it present structurally from a point of view of supply, all of the different things that could disrupt supply, and we've talked about a number of the physical ones. Could this also be an obstruction?
They could. I mean, the major lifters and obviously this whole Russian, the elephant in the room, this Ukrainian invasion has just made it much, much worse. And obviously it's been a cause as well. The major lifters of Russian barrels, on seaborne barrels in particular, have been Trafigura, Vitol, Glencore. So, they're extremely exposed not just to the market and volatility and prices and their LNG positions, but obviously the fact that they have pre-financed a lot of this oil as well. Now, we don't know how much of this pre-financing has come from banks, but some of the money came from them as well. Usually banks would not pre-finance any deal unless the principal gets involved to an extent. So at least until the end of this year, most of this oil has been already paid. Putin's got his money, and now they have to sell it. And that's one of the reasons why you saw that sort of the last Shell deal from Trafigura in the window very openly. I don't think Shell would have liked to have done that deal very openly if it wasn't for the fact that Shell also received a lot of Urals on prepaid basis, on pricing on index basis. So unless you set that price where it really is at minus 30 odd dollars, then you'll pay a lot more. So they actually had to do it very publicly in the Platts window in order to set the prices much lower because they're buying on those prices. So the stress is absolutely real. Yeah.
Christoph, the other big story last week, it seemed to me, the shift in the Fed tone towards a much more robust rate increases going forward. They started with the very tepid 25 basis points earlier this month, but now all the talk seems possibly on a series of 50 basis points hikes. Your thoughts on that shift and what it could mean to everything else in terms of global growth in particular?
This is very hard to tell. I mean, I think the Fed, what they have done is decided to concentrate on their day job, which is inflation fighting, and not to worry too much about implications of the Ukraine. And also, Russia's economy is the size of Italy's economy and shrinking fast. And the connections to the US are marginal. The US is, in that sense, energy independent, that they have now officially even cut off Russian exports. So the Fed sees the inflation rates going up. It sees them going up driven by a strong economy outside of energy and food prices, but certainly made worse probably for the time being by energy and food prices. And it has promised to react, first of all, with the number one weapon central banks use in these situations, which is talking. So get the expectations right. We are not lame. We are not backing away from it because of the Ukrainian war. We will take it seriously to fight inflation. That's very important, to not allow inflationary expectations to become even more unhinged. Whether then really implement 0.25 rates in a row, or whether there will be a 0.5 rate increase somewhere in between, that will be data driven. And I think that's generally true. They don't know themselves right now. They will observe the situation. What is interesting, it seems to have, if anything, injected some sense of stability and some positive acknowledgement that there is guidance now into the market. It didn't create any panic reaction, because I think by now most market participants themselves, they look, the inflation rate is close to 8%, and the interest rate is somewhere 0.0 something. It doesn't match. It is not healthy in the long term. And so I think they did communicate the right story through that window. The ECB and the Bank of England, that will be different ballgames. They will tread much more carefully.
Let's take the survey question before we talk about next week. And of course, there is an OPEC meeting coming. Has the Ukraine war now been priced into the oil market, give or take any other major news surprises? It's kind of a tough question to really, but it strikes me going forward that this kind of 100 to 120, or do we still see this could break up to the 135 where we saw the high at the end of February? But ultimately, overall, does the sentiment that the Ukraine war has now been priced into the oil market give, obviously if there's any other major new surprise, like a bomb lands in Poland, and God forbid what that means for everybody, but yes or no, has it been priced in? Adi, of course, OPEC Plus are meeting next week again. A sort of difficult equation for them, but they seem to be very attached to holding the line and holding this disparate group of 20 odd countries together. Of course, most pronounced Russia in there. And we had over the weekend another attack from the Houthis into the facilities, oil storage facilities near Jeddah, which continues to be a very serious problem for the Saudis, but not necessarily a threat to oil production realistically, but nonetheless, they are referencing it as the reason why they're not increasing oil supply and not sort of being the cavalry to come to the oil market saving, if you like. But your thoughts of where OPEC Plus big challenges as they meet this week?
Well, I think the reason why they're not touching anything is simply because if they could actually from March onward, they could start discussing or renegotiating their quotas again. As we know, OPEC is already underperforming outside the two countries, UAE and Saudis. I don't think that there can be any additional volume anyway. But as soon as you touch the issue of quotas or additional supplies and so on, you're opening Pandora's box. And hey, everything's working just so fine for the cartel. Why would they do anything? And I think they probably won't. Personally, I think I've said it many times. I think it's a mistake on the long-term basis. In the old days, I think Saudis used to think very long-term strategically. At the moment, they don't. They seem to have forgotten. And I think it's just going to blow in their faces like late 70s. It was throughout the 80s they were struggling to stabilize prices on the downside again. I think it's very likely to happen again because this will hasten the move to renewables, nuclear, all sorts of other things out of oil in the medium to long term. But pragmatically, I think that's what I think they're thinking. Well, it's working fine for us now. We don't have to do anything, which is a shame.
Christoph, we thought we'd be having this OPEC meeting as perhaps the first one since the deal with Iran was done. That deal with Iran seems to be always kind of two meters ahead and never reached. It's sort of the shadow you can't grab a hold of. Your thoughts on that and its implications for OPEC decision making?
It's like they say, that's just around the corner. Then you turn the corner is another block away.
Right.
But yeah, it's interesting to think of this in terms of, there's two categories of OPEC spare capacity in the system: of sanctioned countries, Iran and Venezuela, and of the core members, UAE and Saudi Arabia. I think the Iran deal will be pursued further and probably will come to pass, but by now, nobody perceives that as such an emergency that they would have to be given carte blanche. And everybody realized with Russian barrels, the backlog they are floating on sea, competition for illegal oil exports is increasing and prices are dropping. And this is ultimately the sanctions game, remember. So you have to minimize the general increase in the price of oil, which you get from limiting supplies by having stuff being redirected and floating around, and you have to maximize the discount which you impose on Iranian and Russian oil. It seems to be working well. But in this context, I think there's two big unknowns we have to really keep our eyes on. The first one is, in addition to what Adi has said, with the OPEC agreement, they have to rethink something more fundamental, because there is a wrong incentive in the OPEC structure after they were allowed to given the green light to bring prices back up from 2020. Which is that every OPEC member has to announce, how much it can produce, and then the quotas are calculated. So they all announce capacity which they don't have, because when you say, I can produce 5 million barrels, and the truth is only 3 million barrels, the amount you're allowed to produce is higher than if you would have said it's only 3 million barrels I can produce. And this is where this discrepancy comes from, systematic over-reporting of production capacity. And so now when they get to the final stages of producing as much as they can, it turns out that they can't produce as much, and the gap is widening every month. So every $400,000 decision is now 1 million and rising. There will have to come a point where they need to renegotiate that. And remember, they will already adjust after the UAE said we have actually higher capacity now. They have agreed already that Russia, the UAE, and Saudi Arabia will have a change in their quotas based on a change in their presumed capacity. They could use that to make sort of the table clean and say, okay, we start again and we come up with another long-term plan. But I'm also skeptical. I think they're too short-sighted and it's too complicated probably to do that, in which case they will sort of continue to muddle through.
Well, actually, May is the month in which those quota increases begin.
Yeah, until the Americans will seriously lean on them. The other thing, I try to be brief, which we really haven't discussed and should be careful about, is it's not so much that we don't know how much Russian oil is floating around and not being bought. We have a pretty good idea. I think it's 2.5 to 3 million barrels per day based on the satellite data and traders information, and what the IEA also says. But what we don't know is to what an extent that affects Russian production going forward. So to what an extent there's some blockages in the system and the Russians have enough storage space or not, to what an extent it causes, in the longer term, damage in the well if they scale it down. So what we don't have a good idea is to what a degree Russian production is physically scalable. And that could be a significant medium-term effect if they are now backed in and have to lower it, and that they will have to find it difficult under sanction conditions to bring it back up to previous levels. So capacity in Russia may suffer, and that's an important barrier.
Yeah, it is definitely in the midterm when you consider the struggles of new supply from other places. Adi, just before, let's bring in the survey question result and give Adi the last word here. Yes, by a big number in this room at least, that it's priced in. Adi, one thing I wanted to get on that point was the impact for a country like Kazakhstan or others in the sort of caught in the Russian greater sphere. I mean, obviously Kazakh oil comes through the Russian pipeline. What its outlook would be in possible disruption and others?
Well, that's just another addition to traders' headaches, I guess, when you've had this issue with Novorossiysk loading CPC or Kazakh crude oil. It's very, very serious. The country's highly dependent, like the Gulf producers, highly dependent on their oil exports. I think over half of the budget comes, actually about a lot more than a half comes from the oil exports. Capacity of about 1.4 million barrels. There are 3 single point moorings where it's loaded. So they were down, and now they're trying, I think, to bring, I think most likely today, tomorrow, they'll get one of those up. So the capacity, I think, most likely will not be as serious as we originally thought. It's down probably from 1.4 to about 800,000 barrels if this mooring starts operating. And I think within a month or two they'll manage to get the other two repaired. The problem is obviously the sanctions. The problem is obviously the fact that there was interesting news yesterday in the Black Sea. I think a Turkish a boat came across a mine, or what looked like a mine, and that part of the world is just becoming incredibly
a minefield
to operate. Exactly.
Does Kazakhstan have any alternatives to that pipeline?
They do. But originally, when CPC Blend started exporting before the pipeline was built, I've forgotten the names of the place, but essentially you could take it by rail, then across the sea to Baku, and it goes to another so-called BTC pipeline. BTC pipeline has very high capacity, but the problem is because of the rail bottlenecks, you can only export maybe about 250,000. So
the answer, yeah. No, but only to that extent. So 1 point something would be lost.
So that's one to watch, definitely, in this equation. Kazakhstan oil exports could be a collateral damage. We'll have to see, but we'll need to leave it there. Week in review, as always, no better two people, Adi and Christoph. I would just take one note. We didn't even mention China and inevitably the ongoing developments there. I picked out one story worth noting, I think, because I saw it pop up now a few times in the last week. Student demonstrations against continued lockdowns in China. Demonstrations might be a slight exaggeration to use that word in the context of what that might visualize in your head, but it's just protests from Chinese students from having their campuses continuously locked in and their frustrations with that. And if that's any reflection of the wider society in China, which you would have to imagine after 2 years of some challenges and now a heightened one at the moment with COVID, Omicron, and certainly in Hong Kong, you wonder what sort of challenge that presents to China, as we've talked a little bit about over the last few weeks. I just wanted to give it a quick reference. The week ahead, it may be worth keeping an eye on. Thank you, everybody. Have a great day, and we'll catch up every morning, 10:30 UAE time. All the best, Christoph. Thanks, Adi. Have a good day.
Thank you.
Bye-bye.
Thank you, John. Bye.